Hi students. Well, in this final edition of cash flow videos, we're going to look at a fairly comprehensive example of a cash flow statement. And I think this will help you to sort of put it all together. And actually some of these items are a little bit tricky to calculate. And I'm going to go through all of the calculations with you. And hopefully you can apply this knowledge to slightly more difficult cash flow problems. So what I'm doing with this video is I'm setting up an Excel spreadsheet here on one side with all of our information, because I'll have to, as I am doing now, sometimes scroll through this to sort of show you the underlying numbers. And then we're going to put our solution over here in a Word document on the other side, and then we'll talk about the more difficult numbers to calculate on this, and I've got some notes for you about those. So this will be a bit of a long video, but I hope it's worthwhile for you. So here's our company. We are the Snappy Petting Zoo, and we're looking at a comparative balance sheet for 2 years. Now you'll notice that this isn't really a comparative balance sheet, actually. It's just a list of debits and credits. Same idea, though. It will work for us either way. And I think, if you were looking in some accounting books, if you look at a cash flow question, sometimes they just give you increases and decreases, and they don't even give you the balance. Sometimes they give you an actual balance sheet, an income statement, and in this one, I just have debits and credits. Now, those are balance sheet debits and credits, and below here, I have a fairly abbreviated income statement, and then we have some other information. So before we look at the solution, let's just have a look at some of this other information and some of the things we're going to have to look at and figure out to figure out this cash flow statement. So we sold equipment during the year. We paid cash dividends during the year. We exchanged common shares for land. We also exchanged common shares for equipment. So just remember, those are not cash outflows. Those are non-cash financing and investing activities. Now, we have fair value net income investments. We sold some and we purchased some. Complicating our life a little bit, cost of goods sold includes some direct labor cost and benefits and pension cost, and we're going to have to back that out. Other expenses also include some salaries and pension cost. We also paid interest and dividends. Now we're working with, we're working with IFRS here, so we have options in terms of interest and dividends, as we went through on a previous video. So we're putting our interest paid in operating and our dividends paid in financing, and they did say there were no accounts receivable written off during the year. Okay, so when we come up here, allowance for doubtful accounts went up, but we didn't write off any accounts. Okay, so altogether, you should be able to do or prepare a statement of cash flows based on this information using either the indirect or direct method. And of course, you could look at this and go, wow, I'm never going to be able to do this. This is complicated, but you can. So I've got on the Word document here the solution all at once. So we're going to look at the solution. Some of it is really simple and things you've looked at before. For example, if we look at, for example, accounts receivable, well, we can see that there's an increase in accounts receivable. And if we're using the indirect method, you know that means that it represents money that you did not collect. So therefore, a decrease in cash flow compared to your net income for the year. Same idea, we can look at income tax payable. It went up. Well, there's a bill you did not pay, so that's representing an increase in cash for you because you're kind of, in a way, $2,000 richer compared to income tax expense and net income because you increased your payable. So we're going to be looking at some of the easy stuff fairly quickly, and then we're going to move into the slightly more difficult items. So I'm going to scroll up here, and here is our actual cash flow statement of cash flows. So we're picking up our net income. I'll just scroll down here a little bit to show you. Here's our net income for the year. And of course, under the indirect method, we begin with net income, but then we say, hey, net income is not the same as cash. Let's do all of these adjustments to net income to figure out what we actually got in cash from running our business, essentially operating activities. So we're going to go through these and kind of one by one for the difficult ones. But first, let's look at the easy things. Okay, for example, your accounts receivable went up. That means compared to, collecting all your sales, you did not collect all your sales, even more so in year 7. So that's a decrease in cash flow. You increased your inventory, so that means you not only paid for cost of goods sold, but you also purchased more inventory. So that's even less cash again. So those are both adjustments. We're going to talk later about your deferred tax asset. Let's look at your accounts payable and your pension liability. Well, again, your accounts payable went up. That means, in essence, you purchased all these goods on account and didn't pay for them. So that eventually flowed through cost of goods sold on your income statement, but you didn't pay. So that's an increase in cash for us in year 7. I mean, not so good in year 8, right? We're going to have to pay that money. And same idea, we decreased our pension liability. So we owed a certain amount of money, we added our expense, and then we paid even more to make that liability go down. And very similarly, increase in income tax payable. You owe the government more money than at the start of the year. So whatever your expense was, you didn't pay it all in cash, right? So those are the things that should be fairly simple for you, and we have covered in other videos. But now we're going to look at all of these other things, which can be a little bit tricky. So again, that's why this is a long video, but I hope you find it useful. And of course, you have a fast forward button. If there's something that you completely understand and I'm talking about it, of course, you can just fast forward. So let's look at my calculation notes. And the first thing we're going to look at is depreciation. Now, you'll notice here that depreciation expense is $20,000. But what I'd also like you to notice is you have to figure it out. It's pretty nasty actually in this one because there's no line on the income statement for depreciation expense. Well, you know that your year-end adjusting entry for depreciation expense is a debit to the expense and a credit to accumulated depreciation. So to a degree, what we can do is we can start with an increase or decrease in accumulated depreciation to figure out the expense. And you're going to find this with buildings. For example, this represents a $9,000 increase in accumulated depreciation. You didn't buy or sell a building, so that $9,000 increase is simply $9,000 of depreciation for the year. So if you don't buy or sell anything, it's pretty simple. However, we did. If we look down here, we sold equipment, and we probably bought equipment too. So let's look at our equipment account. Where is it here? Our equipment went up. So notice equipment is higher, but we sold some. So obviously we bought some as well. So anyway, we're going to start with depreciation, get back on track here. We'll figure out depreciation, and then we'll get to equipment later. So let's look at depreciation. So if we take depreciation on equipment, well, we're going to say that accumulated depreciation went up 7, right? So we'll start with a $7,000 saying, okay, that's depreciation expense for the year. However, you'll notice, if you recall, in other information here, we had equipment and it was 40% depreciated and it was sold in year 7. Now, recall from financial accounting and disposal of assets that when you dispose of an asset, you have to close out the related accumulated depreciation. So we can see from this line that accumulated depreciation was $4,000 on that equipment, and we took it out. So what we have in that $7,000 increase is up 7, even though we took $4,000 away. So that means we're really looking at an increase of 11 for the year. Now you can do this the other way around. I kind of don't like it the other way around, but we could say, I could start with I could start with that 14, and I could say, well, we sold equipment with accumulated depreciation of 4. So the first thing I'm going to do is take away the 4. I'm back at 10. So how did I get to 21? Well, I had depreciation expense of 11. Now the buildings, again, as I mentioned, is fairly simple. Your accumulated depreciation went up 9,000 and you didn't buy or sell any, so that's just 9. So if we look over here at the Word document, we have 11,000 for equipment and 9 for buildings for a total of 20,000. And that's up here, first number, depreciation expense. Now let's look at the gain on our fair value net income investments. And what I'd just like to remind you of is under the indirect method, if we have a gain on the income statement, that gain is part of our $76,000 here, but it is actually an investing activity. So we need to back out that gain, okay? And let's notice that the answer is 24. Let's see how we get to that. Now, I'm sorry about all this flipping back and forth, but that's about the only way we can do this. So we're gonna take the gain on the sale, and we have to just simply add it back to to operating activities. Wait a sec. Whoa. Deduct it from operating activities so that our net income only represents operations. Okay, and your gain is right here in the income statement, so that wasn't too bad. Now, how do we know that we lost money on equipment, or actually, how do we know? Well, equipment is fairly simple. What we can do here is we can look at the income statement, and we can see that we lost $3,000 on the sale of equipment. And here's the equipment that we sold. So obviously, this is the equipment. Okay. Well, we need to know what we sold it for, don't we? We need to know the proceeds on sale for our investing activities, and we can now calculate that, because if you remember your basic financial accounting, the book value of your equipment, I'm just going to go down here because I wrote it out. The book value of your equipment is historical cost minus accumulated depreciation, in this case, 6,000. Your loss was 3, therefore you sold it for $3,000. There, pretty basic, right? And initially, if you're doing the operating activities, you could just go to the income statement and say, oh, look, there's a loss, I'll add it back. But we still need to calculate how much money we got for it, for our investing activities, and we've just done that. Okay, now here's something that you may or may not well, actually you should be familiar with if you're sort of at the end of your intermediate financial accounting courses. You've done income tax, so you know what a deferred tax asset is. And you'll notice that that would then be on the balance sheet. Here's our deferred tax asset, and it went down $4,500. So, okay, decrease in deferred tax asset. I guess the trick here is, do you know whether you should be adding this back or deducting it? So let's just kind of look at my note on tax asset. Just a reminder here, okay? A deferred tax asset means that, there was a temporary difference, such as like warranty expense or CCA, and you had to pay more tax because you weren't able to claim as much on your income tax as your expense was on your financial records. So we paid too much money to begin with, so to speak. When that deferred tax asset goes down, it means your temporary difference is reversing. You're now paying less tax and you're using up that deferred tax asset. So if you are paying less tax now, then that means it's an increase in your cash. So decreasing your deferred tax asset essentially gives you more cash flow than net income, because you've got your income tax expense, but you didn't have to pay it all. You used up some of your deferred tax asset. Okay, now that's pretty much it for operating activities. These other three items are pretty basic, and they're just over here on the balance sheet. And if you want to have a closer look at these, you can just pause the video right now, and I've got the balance sheet showing and these as an answer. So you can just have a look at those. But let's now look at some of the more interesting things as we move to investing activities. And the first thing is, well, did we buy fair value net income investments, and how much did we buy? So let's look at fair value net income investments. We went from 80 to 59. Now, this is possibly anyway, the most complicated item in this cash flow example. So I'll leave this up on the one side of the screen, and let's just look at how we did that. So here's my note right here on fair value investments. Now, you'll notice that at the end of year 6, you had 80,000. Now, you sold you sold investments that had a book value or carrying value of 37. I'm going to show you this down here. They cost 35, but on December 31, year 6, you had done your unrealized gain, and they are now sitting on your books at 37. Okay, so when you sell those, you have to take them off of your statements. So you're going to credit your fair value net income investments. So we start with our 80 at the end of year 6. We take away the 37, you should have 43. But you don't have 43, do you? We look at this, we have 59. So we're not done. We had an unrealized gain of 11,000. And I'm going to show you this here. Right here in other income, they're pretty nice to you. They told you the number. We have an unrealized gain during the year of 11,000. Okay, so unrealized gain, of course, means no money, right? So that means, in effect, that we only bought $5,000 worth, okay? And again, I'll go up here, and fair value net income is 59. So we end up with $5,000. Now, again, just to double check why we got there or how we got there, after the sale, you should have had 43. And that would be the carrying value of your investments. We add the unrealized gain at the end of the year, which is a debit to investments and a credit to gain, giving us 54, but we ended up with 59 anyway. And the difference between the 54 and the 59 means you bought $5,000 worth. Okay, what else do we have here? We have the purchase of equipment. Well, let's look at what happened here. Right here somewhere. Okay, so when we look at the purchase of equipment, we're mixing two things, right? We're mixing the sale of equipment, which came off our books, with the purchase of equipment that went onto our books. And the one thing that makes this not too tough is that equipment is recorded at historical cost. So if we look at equipment here on the balance sheet, we can say that we went up $22,000. Now that's good because it's historical cost, but we also know that equipment with a historical cost of $10,000 was sold. So I'm going to add those together, and I'm adding them because of this. Like if we started with that 48 and we took away 10 during year 7 for that sale of equipment with a historical cost of 48, that would leave us with a balance of 38, right? So that's why I'm adding that 10, and therefore we would have 32. However, this is more complicated than that. We didn't just buy 32, because if we look at this other information, 2 times we exchanged common shares. Now, I know this says land. Let me see, here's equipment, sorry. Our common shares issued for equipment were 20,000. So even though our equipment increased by 32,000 in the year, 20,000 was financed through an exchange of shares. So we have to take that 32, subtract the 20, and we're left with 12,000, which is your actual cash outflow. And a note to your statement, let me see if I can find this here. A note to your statement, non-cash investing and financing activities says that we issued common shares for equipment 20,000. Now we did the same thing for land. Land's pretty simple. Land just went up by that 15. So we didn't pay any money for the land. The 15,000 of shares issued is a straight increase of 15,000 to the land account. So we're fine there. Okay. Now we already talked about the sale of equipment and the fact that we actually sold equipment for $3,000. Now the proceeds on sale of fair value net income investments was just handed to us in this line here. It told us in year 7 we sold them for $50,000. So that's of course the cash inflow. So that's all our investing activities. Now we have then a few, like 3 financing activities, and let's kind of look at those. Now our long-term notes payable went down 8,000, and there's nothing in the other information that talks about long-term notes payable, so we just know that we paid off principal of our long-term note. So lucky for us, that was pretty easy. That's just a cash outflow to pay down your liability. But how do we get to dividends? Now, you might know this already. You probably do. If you were to take beginning retained earnings and you were to add net income and you had paid no dividends at all, then that would be the new balance of retained earnings. But our 90,000 beginning retained earnings plus our 76 net income is 166, our ending retained earnings isn't 166. Well, how did that go down? Now, this could get complicated in real life. In real life, you know that a company might do some crazy things like, repurchase shares on the open market for more than the original issue price, and that could cause a debit to retained earnings. So, cash flow statements in real life can get kind of crazy. However, for us, we don't have 166, we have 92. And I've put this in a note. Let's just look here, dividends paid. We take our 90, add our net income, we should have 166. However, we only have 92. The difference is 74,000, and that's how much we paid. Now, if this were a tiny bit more complicated, we would have perhaps a dividends payable account. And if your dividends payable went up or down, that would influence the cash paid for the year. But for us, that's not going to be an issue. So we are at 74. The only number that we really have left is, what about common shares? Did we issue common shares during the year? So it doesn't tell us, does it? I don't think I see that here. Well, let's look at common shares. We went from 250 to 300. So we increased 50,000, and from this other information that $35,000 worth of common shares were exchanged for land and equipment. So let's look at just my note here on the shares. This is a fairly simple calculation. We went up 50. Of this, 20 was in exchange for equipment, 15 was in exchange for land. I take that away. I actually issued shares for cash, $15,000. So that's kind of a wrap on this statement of cash flows indirect method. And there were lots of things in here, and I think if you do this kind of slowly and carefully, you can pick up a lot of information here and use that in other questions and problems. Now, it's nice to know both methods. So as you may be aware, IFRS prefers the direct method, and most companies don't use it. They kind of like the indirect method. It's pretty traditional. They're easier to figure out. So we're still going to do the direct method. And again, just a reminder, the only difference between the direct method and the indirect method is how you present your operating activities. Under the indirect method, we start with net income, and then we realize net income is not cash income, so we do all of these changes. Look, there are a lot of changes to net income to get, what's our cash operating income? 60. Well, 60 is still the answer. So, these have to match. If you're doing both and the answer is 60, it has to be 60 when you've finished the other one. So let's look at the direct method operating activities now. And I've got a whole bunch of notes here as well. So here they are. Here are the items that we're going to, many of them that we're going to look at. Cash received from customers is our one big cash inflow, and all of these items are our cash outflows for operations. So what about cash received from customers? This is pretty simple. We sold 960, but our accounts receivable increased. So we actually only received this much money, $940,500, from our customers. Now there are a couple of things in here that are a little complicating for our cash outflows. Mainly the complication is that we've included labor cost and salary expense sitting here in cost of goods sold, and operating expenses. And mainly what we need to do is back those out, because we have to separate in the direct method money paid to suppliers for goods and services versus money paid to employees. Okay, so we're going to split those out. So let's just kind of look at cash paid to suppliers for goods and services. We're going to start with our income statement, cost of goods sold, and we didn't, pay our employees as a supplier, so we need to back off the direct labor, the pension expense. So that's from our other information here. It says, includes 115 of direct labor and 11.7 of pension. So those go away because those are paid to employees, and we're going to have them on another line. Now also, in addition to cost of goods sold, we increased our inventory level by $14,000. So you had to pay for that as well, or not. So first we're going to add our increase in inventory, and if we look up here, we can see our inventory went up $14,000. But the question is, did we pay for it? And if we look at accounts payable, you see that your accounts payable went up $12,500. Well, that's money you did not pay. So we have to deduct the increase in accounts payable. So this means we paid our suppliers this much, $474,800. Now let's look at other operating expenses. In terms of other operating expenses, $250,000, and that's right here on your income statement. But of that, we have 76 for salaries. We have 8,000 for pension that has to come off. And as you know, depreciation is a non-cash expense. So we can't have depreciation in there. It has to come off. And bad debts expense is non-cash as well. I mean, it's just an adjusting entry, right? You don't pay, when you write off an account receivable, you don't give them money, they just don't pay you. So there's no cash effect for bad debts expense. So we have to take all of those off, and the only reason we're taking them off is that they're already included in operating expenses, leaving us $144 paid to suppliers. So just kind of backing up, we're here. We've looked at these first three numbers. So we have three more things generally to look at. Cash paid to employees. Well, this is simply the addition of all of those numbers that we backed out to begin with. So the labor, the wages expense, the pensions, and our pension liability went down. Remember from the operating activities in the indirect method? Well, because that went down, it means we paid more money than pension expense to cause a decrease in that liability. So we're at 213.2. Now, in terms of tax paid, this is slightly complicated. We could take our income tax expense right here, $45,000, and two things happened. Remember that deferred tax asset that decreased? That's using up your deferred tax asset instead of giving CRA money. So in terms of cash outflow, we did not pay that $4,500. And our income tax payable went up. So we actually chose, or were allowed to for some reason, to pay them even less. So our debt to CRA increased, so we didn't pay that part either. So we only actually paid cash $38,500, even though our expense was $45,000. And interest is the last one. Interest is simply, there were no adjustments to interest. So your interest of 10 is just what you paid. Because if you look at your payables, here, there is no interest payable account. If there was, we would have to adjust for it. So what I'd like you to notice is that we did get to $60,000 as cash provided by operating activities. So that brings us to the end of this, I know, incredibly long example. I just hope that you found that worthwhile.